Whole life insurance is a fantastic asset, but since life insurance just invests in bonds anyway, why don't you just cut out the middleman, buy the bonds yourself, and save all the expenses that you'd otherwise pay to the insurance company? I've certainly been asked a time or 15, especially by a number of generally newly minted CFPs, why it doesn't make sense to just go out and buy the bonds that life insurance companies are going to invest in anyway to cut out the expense of insurance fees and take advantage of the returns that the insurance company would potentially otherwise keep and have more control over your future savings destiny. But really, seriously, the bond market is not the stock market. You may not be thinking about this because you've probably never yourself attempted to directly invest in the bond market. But I assure you, it's an entirely different ball of wax. Most of you think you know somebody who invests in bonds. You might even think you yourself invest in bonds. But you don't directly invest in bonds. Most retail investors invest in bond funds, which gives them access to corporate bonds, but that is not the same as investing in corporate bonds. Outside of that, your typical retail investor gets direct bond exposure primarily by buying either municipal bonds or treasuries, which are very different from investing in the corporate bond market. Purchasing direct issuances of corporate debt is tricky. Yes, there's a market, and yes, you can do it, but it requires a certain amount of sophistication and money that most retail investors either don't have or are not looking to commit to. Case in point, unlike the stock market, where you can log on to basically any brokerage platform that exists and easily call up stocks and know instantly what their market clearing prices are, the same mechanisms don't exist for the bond market. In order to look up and purchase a specific corporate debt issuance, you first have to know its CUSIP, which is already a complicated area that most retail investors are unfamiliar with. And then you have to decide if the price you're being offered is really a good price for the bond. Bond brokers have a lot more ability to mark up bond prices, so you never really know if the price you paid was the best price of the day or the worst price of the day. You also need a lot more money to invest in bonds because whereas you can buy stocks for a couple of bucks in most cases in fractional share amounts, bonds come in much larger chunks, and therefore they're going to require a much larger commitment of your portfolio. And while owning direct issuances of corporate debt is a way to generate income that is, for the most part, guaranteed to you, it's an extremely difficult way to make money from the standpoint of capital appreciation. But I assure you, there are many bond traders who do this on the regular. I've been in this industry for quite a while. I've met thousands of different people who are retail investors, and I can still count on one hand the number of people who actually bought corporate debt issuances directly as an investment. It's an extraordinarily rare thing for retail investors to do. Institutional investors, specifically institutional investors who specialize in buying corporate debt, very rarely go on the search for those debt issuances. Instead, those debt issuances have a way of finding them. Given their vast networks of other individuals inside the industry, both as investors themselves or issuers of the debt, they have a pretty good network that allows them to assess the overall good or badness of pricing that they might receive on a bond solicitation. You, I assure you, will lack the same sort of insider knowledge and network of friends who can help you assess those things in the moment. In fact, it happens to be the case that we have a few bond traders who are clients of ours. They bought life insurance from us, and all of them have echoed the same sentiment. Once they come to understand what life insurance, whole life insurance, or index universal life insurance is all about, they all kind of make the same remark. It's a lot like bonds, except a lot less complicated with a lot more liquidity. Now, you may be thinking to yourself, I'll just buy the bond funds, especially the ones from Vanguard, the Admiral share styles, or whatever it is these days with low expenses. That'll be good. maybe, but that's not exactly buying direct and cutting out the middleman. And yes, right now you can buy treasuries at some pretty killer rates. And I'm sure municipal issuances are looking quite good these days, especially given the taxable equivalent yield. That may be one avenue to pursue, but there's still several things that separate life insurance in terms of its functionality as an asset class from buying direct issuances of debt, be it corporate or public. First, getting back to the subject of buying bond funds, let me point out to you that the people who manage general accounts at life insurance companies have a very different mandate when it comes to the investment strategy they have to employ. Life insurance companies issue contracts that bring with them obligations. Those obligations have to be met with income that the insurance company seeks to generate. The number one driver of income that meets the requirements of those obligations is investment income generated by the general account. So think of it like this. When an insurance company has money that it has collected, it is seeking a rate of return that hits a certain hurdle. No such hurdle exists for a bond fund manager. On top of that, even though the insurance company's investment management team is tasked with the job of generating income sufficient to meet the needs of the obligations, we call those reserves in technical insurance speak, of the contracts that are issued, there's kind of a societal pressure among life insurers to do even better than that. In fact, it's this excess investment return above those obligations that feeds primarily the dividend that's payable on dividend-paying whole life insurance. Even within the industry's accounting principles, there is a metric that we follow at the Insurance Pro blog to assess how well insurance companies generate investment income in excess of the contractual obligations that the insurance company has outstanding. We do this because it's our fundamental belief that the better an insurer can exceed these obligations, the more capacity it has to fuel non-guaranteed accumulation features of its insurance products. And our empirical data shows us that those who maintain healthier margins of investment income relative to their obligations have, in general, issued policies that have performed better from a cash accumulation standpoint, at least insofar as we look at the ones that we have put in force. It's also life insurance, so it brings to the table an array of tax features, favorable tax treatments that you would never get as an individual investing directly in bonds. Even on the subject of municipal bond income, which is, for the most part, tax-free in a lot of circumstances, there is an ability with life insurance to compound values in a fashion you'll never find available on a municipal bond investment that continues to be tax-deferred and tax-free upon distribution, provided that it's done correctly. The tax-favorable aspects of life insurance, cash value life insurance, is a little bit intimidating to dive into as a discussion because there's several of them. And the truth of the matter is, it really is special given the combination of those features, not just any singular aspect of the tax-favorable, tax-free elements of a whole life insurance contract. In other words, unlike, say, a municipal bond, where the income generated by the bond is tax-free, and that really is the tax benefit of it. There are other things, other aspects about municipal bonds that are not necessarily tax-free. For example, if you buy a municipal bond and interest rates go down and you decide to sell the municipal bond because it's worth more than you paid for it, the capital gain that is recognized from that sale is fully taxable to you at taxable gain rates. So if you need or decide to liquidate your position in the municipal bond purchase, you may end up with a taxable implication on the cash you receive. Again, to be clear, the income will remain tax-free, but selling a bond at a gain, be it a corporate bond, a treasury, or a municipal bond, will in fact carry a tax liability with it. A lot of people like to point out that Roth IRAs are tax-free, and they are, and they enjoy a number of really great tax benefits as well. But they also have some strings attached that life insurance simply does not. You do not have access to the gain in a Roth IRA as a tax-free distribution until you reach age 59 and a half. No such limitation exists with life insurance contracts. If you decide you need to distribute cash from life insurance at age 45, 50, 55, it does not matter. There is no penalty for a withdrawal before a certain age. And let's not forget that it's life insurance. There's a death benefit that can be received income tax-free to a lot of different people and entities. So your ability to grow and distribute wealth in an extremely tax-efficient manner is something that's a little hard to overstate when it comes to the tax features of life insurance. And on the death benefit side, let's not forget that rate of return is pretty solid on most well-implemented life insurance policies, and the death benefit is just an added feature. But I think the most critical difference in terms of feature that you get from a life insurance contract versus just investing in bonds, be it direct issuances or bond funds, is the fact that life insurance policies come with an extremely solid protection of principal and liquidity that those options generally don't have. If you invest directly in bonds, you'll have to sell the bonds. So not only is it complicated to buy direct issuances of corporate debt, it's even harder to figure out how you're going to sell them if you need or want to. And just like there's no way to figure out if the price you're paying when you buy is a good price, there's no way to tell if the price you're getting paid when you sell is a good deal or not. Life insurance cash values, on the other hand, have an immediately recognizable value associated with them. You can look up the cash value in any given day of the year. That cash is accessible to you anytime you want it. And the principal is protected from loss. So if market conditions are changing, you don't have to worry about marking to market if the assets underlying at the insurance company are falling in value. You also have much more granular control over the amount of cash you might extract from a life insurance policy than would ever be the case if you were investing directly in debt. To sell bonds, you'd have to sell them in the chunks you bought them, which may be more money than you need at any given time. Otherwise, you'll have to wait for the income to produce the cash you want or need. Life insurance, you can choose $1, $10, $50, $10,000, $150,000. You have much more control over that. Now, not only is it really difficult to invest directly in bonds, not only do life insurance investment teams have a significantly different objective that's actually aligned with your goals versus a bond fund manager, not only are there great tax benefits to owning life insurance and a wonderful array of liquidity features that are not present in directly buying bonds. But there's something else about this argument that is very, very myopic. And that's the fact that life insurers, yes, invest in bonds, but it's not the only thing they invest in. And while, yes, it is generally true that the majority of the assets held by the insurance company are invested in bonds, it is not the case that there are no other style of investments the insurance company is pursuing. And those other investments can lead to significant gains that are then paid to policyholders, be they through dividends or simply special interest payments on the cash value accumulated in something like a universal life insurance product. And speaking of universal life insurance products, the indexing features of indexed universal life insurance specifically involves an investment strategy that is not entirely impossible to replicate as a retail investor. It does require a certain level of sophistication and risk of getting it wrong that a lot of insurance companies have ironed out in a way that would take you many years to do. Plus, there's the fact that as institutional investors with billions of dollars to invest in these style assets, they have much more leverage when it comes to pricing that would be favorable to their objectives that you simply will not have. We've known of life insurance companies that have done things like purchasing radio towers to lease airway space to radio stations and such as another form of diversified income in their portfolio. Some have bought private jet companies that lease out private jets to people who want to fly private but don't want to own their own jet. Others have been extremely early investors in social media platforms that have created investment gains and exits that were enough to pay the company's dividend for a few years to its policyholders. It's about way more than just buying the bonds, which means it's about way more than you just foolishly trying to buy a couple of corporate debt issuances in a way to not pay insurance fees. The risk of doing it wrong and losing your money is so much higher than what you're going to pay as far as insurance expenses are concerned. And while this may sound really appealing when you're young and or inexperienced to these sorts of things, let me tell you from the vantage point of perspective here that as time goes on, your desire to partake in complex investment strategies that you yourself have to sit down and orchestrate every day, it's probably going to wane over time. Most of the people that I have met who invest professionally, some of them, the successful ones, do generally make a lot of money, but almost all of them, at least the ones that I have met, have the objective to make enough money in a short enough period of time to stop doing this because it's stressful and it's complicated. They dream of a day when they can cash out and not have to deal with all that complexity. And if you think that you're going to walk into directly investing in bonds, similarly to the way that you might directly invest in an index ETF, you have a lot to learn about how that market works. And while the idea of investing directly and skipping the middleman and saving the expense may seem really appealing, I've never actually met anyone who's pursued it and succeeded. And I've sold a lot of life insurance to people who are extremely sophisticated investors. But if you happen to think you're really special and you got something going that I'm just missing the boat on, feel free to let me know. Just don't overlook the fact that when the market moves against your favor and people incur heart-crushing losses, those situations do unfold inside life insurance company general accounts, but their policyholders never feel the impact. And that's something that you cannot overlook in the pursuit of cutting out the middleman. And I would also be quick to point out to you that there are an array of safety measures that insurance companies use to hedge circumstances where assets they invest in might become impaired, as the industry likes to say. Investment positions that exist solely to buffer bad times. Positions that are not just good practice, they're required by law. Things I can almost assure you aren't going to think about nor try to do if you're going to cut out the middleman and invest directly yourself. So if you think you know better than an industry that is managing trillions of assets and doing it in a fantastically successful way of slow but successful growth, have at it. But I think there's a lot of things they know that you don't, and you don't even know you don't know them.